Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Bitmine Immersion Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine a single corporation quietly buying up like 5% of the entire internet's foundational real estate.
Yeah, and not even to build on it right away necessarily, but specifically just to create massive artificial scarcity.
Exactly. That is the exact scale of the wealth building scenario we are unpacking for you today.
It really is, and it represents a complete reinvention of a company, We're examining an organization that has executed a massive fundamental pivot.
Right, because they're no longer just a low-margin Bitcoin miner.
No, not at all. Mining is essentially this brutal, labor-intensive grind, right? You're plugging in machines, paying massive energy bills.
And just hoping the math works out in your favor day by day.
Exactly. Well, they have completely abandoned that model. Instead, they've transformed into this high-growth Ethereum, Treasury, and staking powerhouse.
Which is really the core of what we need to figure out for you, the listener, today. The mission here is to analyze if this unique investment vehicle, which essentially functions as an Ethereum bond, is the ultimate blue sky opportunity for the medium-term investor.
Or if it is actually just a highly leveraged risk that's masquerading as financial innovation.
Right. So to understand what you're potentially buying into here, we really have to look at the sheer staggering scale of their ambition. I mean, management calls it the alchemy of 5%.
The numbers are wild. As of April 12, 2026, Bitmine has accumulated 4.875 million Ethereum tokens.
Wow.
Yeah, that represents 4.04% of the total global supply of Ethereum in existence.
Just pause and think about that number for a second. 4% of a global decentralized asset owned by one publicly traded entity.
It is massive, and it puts them 81% of the way to their ultimate goal of hoarding a full 5% of all Ethereum.
That's just, I mean, if you look at the total value of their crypto, their cash reserves, and their strategic investments, their balance sheet sits at an $11.8 billion valuation.
Right, and they are aggressively continuing this accumulation. Just in the past week alone, they scooped up another 71,524 tokens.
The real estate analogy really helps ground this, I think. Imagine a property developer who suddenly realizes that building new, low-margin houses is a terrible business.
Yeah, the supply chains are messy, the labor is expensive.
Exactly, and the margins are razor thin. That was their old mining business. So instead of building, they just stop. They decide to use their capital to aggressively buy up 5% of all the prime, undeveloped land in a major city.
They aren't laying bricks anymore. They are cornering the market on the underlying commodity to force artificial scarcity.
Right, that is precisely the mechanism at play. They are transitioning from the energy-intensive business of digital labor into the purely financial business of asset accumulation.
And by targeting such a colossal percentage of the total supply, they're deliberately engineering a supply shock. I mean, if there are only about 120 million total Ethereum in existence, and one single Wall Street corporation locks up 6 million of them, what does that do to the open market?
It violently constricts the available supply for everyone else.
Exactly.
But, while they are acting as a massively leveraged proxy for Ethereum, they're also making some very interesting strategic hedges. They recently deployed $85 million to 8Co to get direct exposure to OpenAI.
Which is so smart because it highlights that management isn't entirely blinded by crypto maximalism. It provides an asymmetric upside totally distinct from the digital asset ecosystem.
Right, like if the crypto market goes sideways or enters a prolonged freeze, they still have a significant stake in the artificial intelligence boom.
Yeah, it's a vital shock absorber for a wealth-building portfolio.
They're also playing ecosystem politics. I saw they bought 5,000 tokens directly from the Ethereum Foundation. Why do that instead of just buying them on the open market?
It serves two brilliant purposes, actually. First, buying directly financially supports the core developers who maintain the network's operations. You're essentially paying the people who keep the lights on for the asset you're hoarding. And second, it keeps those 5,000 tokens completely off the open exchanges.
Oh, because if the foundation dumped them on the open market to raise capital, it would create downward selling pressure on the price.
Exactly. Bitmine absorbs that blow quietly over the counter.
Okay, but here is where we need to push back a bit and really examine the mechanics of this strategy.
Sure.
Because owning 5% of the prime real estate in the city sounds incredible on paper, but how does that raw land actually generate cash flow for you? Sitting on an asset doesn't pay out dividends. We have to move from just asset accumulation to revenue generation.
Right, and that brings us to the operational engine of this entire pivot. They aren't just sitting on these tokens in some digital vault. They're actively utilizing them through their proprietary infrastructure, which they call the Made in America Validator Network.
Or Maven.
Yes, Maven.
Wait, before we start throwing around the acronyms and the revenue numbers, explain what this actually means to someone whose wealth-building strategy is rooted in traditional finance. You mentioned they are staking these tokens. How does locking up a digital token magically produce cash yield?
It's a great question, and honestly, it's the most misunderstood part of this asset class. In traditional finance, if you buy a treasury bond, the government pays you a yield for lending them your capital.
Right.
But in the Ethereum network, there is no central government. Instead, the network needs participants to verify and process transactions to keep the system secure.
Okay.
So when Bitmine stakes their Ethereum, they are essentially locking up their tokens as collateral, proving they have skin in the game. In exchange for providing this security and computational validation through that Maven infrastructure, the network automatically pays them a portion of the transaction fees generated by users globally.
Ah, I see. So it is functionally similar to a dividend yield, but instead of a company sharing corporate profits, it is a decentralized network, paying you for providing the cryptographic security that makes the network function.
Exactly. You are getting paid a baseline yield for providing foundational trust to the internet. And the numbers on this Maven yield machine are absolutely staggering.
Let's hear them.
As of April 13th, 2026, they have actively staked 3.334 million of their tokens. That is $7.4 billion worth of Ethereum put to work.
Wow.
And it is currently capturing a 2.89% yield.
A nearly 3% yield on $7.4 billion.
Right, which generates an enormous $212 million in annualized revenue right now. And remember, they haven't even snaked all their tokens yet.
Oh, right.
Yeah, when they reach full scale and deploy their entire treasury, that revenue stream is projected to hit $310 million purely from network validation fees.
Okay, so on paper, they have built this massive cash-gushing yield machine. But we have to address the giant, terrifying elephant in the room here.
I know exactly what you're going to bring up.
I'm talking about their recent earnings report. For the quarter ending February 28, 2026, they reported a net loss of $3.82 billion.
Yeah.
Hold on. Let's stop right there. You cannot just wave away almost $4 billion. If I am an investor focused on capital preservation and long-term wealth, and I see a $3.8 billion loss sitting on a balance sheet, my absolute first instinct is to run screaming for the hills.
Totally understandable.
Prove to me this money isn't actually gone. How is this not a sinking ship?
Your instinct is exactly right for a traditional equity, and it's why so many retail investors panicked and sold. But to understand why the institutional investors didn't blink, you have to look under the hood at the extremely specific accounting rules governing digital assets.
Okay, explain that.
Management and the institutional bulls backing the company view this massive $3.8 billion number strictly as an accounting artifact. It comes entirely down to fair value mark-to-market rules.
Break down the mechanics of that for us. How does an artifact cost $4 billion?
Okay, imagine you own a massive apartment complex outright. You have tenants in every unit, and they are paying you rent flawlessly every single month. Your cash flow is fantastic.
Sounds great.
But let's say the broader commercial real estate market experiences a sudden, brutal crash. The fair market value of your physical building drops by 40% over 3 months.
Right. If I tried to sell the building today, I'd get much less for it.
Precisely. Under current corporate accounting rules for digital assets, if the spot price of Ethereum drops during a given quarter, the company is legally required to report the decreased value of their entire $11.8 billion Ethereum treasury as a formal loss on their income statement.
Wow.
Yeah, this is required even though they didn't sell a single token. It is an unrealized paper loss.
So the tokens are still sitting there?
They are still sitting there, and
Wow.
more importantly, they're still generating that exact same 2.89% yield through a van. The operational engine of the company, the $212 million in staking revenue, is working perfectly and churning out cash.
It's just a paper loss.
Right. The balance sheet just looks historically ugly because the underlying asset had a highly volatile quarter in price.
Okay, that clarifies the mechanics significantly. The cash flow is independent of the daily price swings of the underlying asset. But even knowing that, a $3.8 billion headline number is enough to trigger mass panic.
Oh, absolutely.
To understand why a wealth builder might want to look past that terrifying number and hold their position, we need to look at who is doing exactly that. If this loss is just a paper illusion, who is actually buying that story?
We have to follow the smart money. And the institutional backing here provides a massive credibility moat. We aren't talking about retail day traders who get easily spooked.
Who are we talking about?
Top-tier, long horizon players, Cathie Wood's ARRK Invest, Bill Miller III, and Peter Thiel's Founders Fund are all deeply embedded here. Thiel previously disclosed a massive 9.1% stake in the company.
And institutions like that don't deploy capital of that magnitude without running forensic audits on the balance sheet. They clearly understand the mark-to-market accounting rules.
They do. And more importantly, they are looking at the liquidity runway. Bitmine has $719 million in total cash liquidity sitting on hand.
That's a huge buffer.
It is crucial because it means they have an exceptionally long runway to service any of their corporate debt. If Ethereum's price stays suppressed for another year, Bitmine won't be forced into a margin call where they have to sell off their core Ethereum positions at a catastrophic loss just to keep the lights on. They can easily weather the storm.
Speaking of weathering storms, let's look at the macroeconomic and geopolitical tailwinds driving this institutional conviction right now. The chairman, Tom Lee, is essentially putting his entire reputation on a line. He is aggressively declaring that the mini-crypto winter is officially ending.
His thesis is heavily tied to the current geopolitical instability. He points specifically to the ongoing Iran war macro environment.
Okay.
He notes that since the start of that severe geopolitical conflict, Ethereum has actually outperformed the S&P 500 by 24.5%.
That is a massive decoupling from traditional equities.
It really is. The narrative on Wall Street is beginning to shift toward viewing certain digital assets as a wartime store of value.
I really had to challenge that wartime store of value thesis, though. For thousands of years, gold has been the ultimate safe haven because it is historically reliably boring. It barely moves in price. It just quietly holds its purchasing power while fiat currencies collapse.
That's fair.
But Ethereum is still incredibly volatile.
Yeah.
We literally just spent 5 minutes discussing how extreme price swings cause a $3.8 billion paper loss. Does Ethereum's massive price volatility truly make it a safe haven compared to traditional gold during a global conflict?
That is the critical tension, and it's the exact debate happening in institutional finance right now. You are absolutely right that it does not behave like gold in terms of daily price stability. However, the counter-argument, and the reason it is outperforming the broader market by nearly 25% during a war, is about the mechanics of portability and seizure resistance.
Explain the difference. Safety of price versus what?
Safety of custody. Exactly. In the severe borders-closing geopolitical crisis, physical gold is an extreme liability. It is incredibly heavy, it is hard to move across military checkpoints, and it can be easily confiscated by a desperate, cash-strapped government.
That makes sense.
But digital assets, however, can be stored in your head with a 12-word seed phrase and moved across international borders instantly without asking anyone's permission.
Oh, wow.
So while the daily fiat price of the asset is volatile, the physical accessibility and absolute ownership of the asset is viewed as highly secure. That technological guarantee is the premium investors are currently paying for in a wartime environment.
That makes perfect sense. It's an entirely different category of safety. So if the heavy-hitting institutions are buying this geopolitical narrative and they understand the accounting rules, are they actually stepping into the market? How is this translating to the stock's price action right now?
To see that, we look at a massive transformational catalyst that just played out on April 9th, 2026. The stock successfully uplisted to the New York Stock Exchange.
Let's unpack the mechanics of that, because for a lot of retail investors, an uplisting just sounds like a cosmetic prestige thing, right? Like a new ticker symbol on a different screen. But it actually changes the plumbing of institutional finance, doesn't it?
It fundamentally changes who is legally allowed to buy the stock. Many massive institutional funds, pension funds, and endowments have extremely strict, legally binding mandates that prohibit them from buying stocks traded on smaller exchanges or over-the-counter markets.
Because the risk profile is considered too high.
Exactly. By clearing the regulatory hurdles to move to the big board at the New York Stock Exchange, Bitmine unlocked a massive, previously restricted pool of fresh institutional capital.
And we are seeing that fresh capital flood in right now. The liquidity metrics are insane. It is currently the 117th most traded stock in the entire United States. It has a 5-day average daily dollar volume of $747 million.
It's massive volume.
$747 million a day. That rivals massive household name blue chip companies like Intuitive Surgical. That is not retail money. That is institutional accumulation. But what is the actual price chart showing us?
Well, let's go back to that $3.8 billion paper loss. In the technical analysis world, an event that terrifying acts as what we call a washout. It triggers a massive wave of fear, and all the weak hands, the retail investors who didn't understand the fair value accounting rules, sold their shares in a blind panic.
They basically flush themselves out of the market.
Exactly. But once that tidal wave of panic selling exhausted itself, the stock found a very firm technical support floor at $20. The institutional buyers stepped in at $20 and refused to let it fall further.
So it established a real baseline.
It has established $20 as the absolute baseline. However, it is currently trapped, bumping its head against a very heavy resistance ceiling at $23.
Right, and when you look at a chart, resistance at $23 isn't just a magical line or a psychological dam.
Yeah.
It is an actual physical wall of automated sell orders. It's essentially a graveyard of investors who bought the stock right before the $3.8 billion earnings report crashed the price down to 20.
Yep.
Now, every time the stock crawls back up to $23, those burned investors eagerly sell just to break even and get out of the trade.
That is a perfect way to visualize it. It is a wall of supply. But here is the critical setup that technical traders are watching with the prestige of the new New York Stock Exchange listing, unlocking all those giant pension funds and endowments. Could that fresh daily $747 million in institutional volume be the flood that finally overwhelms that wall of supply at $23?
If it breaks through 23 with high volume, it signals that institutional demand has completely absorbed the retail fear.
Yes, potentially sparking a major upward reversal.
So if you are a wealth builder sitting in this channel between a $20 floor and a $23 ceiling, you need to know what upcoming events are going to dictate the next breakout or potentially a breakdown. Let's look at the catalyst calendar for the next 3 months. And crucially, let's dig into the risks. How can this go wrong?
The most immediate catalyst is their upcoming earnings report. They need to prove to the market that the Maven cash flow is real. They need to show that $212 million annualized revenue actually hitting the income statement, completely independent of whatever Ethereum's price did that quarter.
That makes sense.
Alongside that, they are aiming for the full 100% deployment of the Maven infrastructure for all 4.8 million of their tokens. That milestone maximizes their yield capture and proves the tech scales.
There are also massive regulatory tailwinds brewing in Washington that could act as catalysts. Prediction markets are currently giving a 68% chance for the Clarity Act to pass in 2026.
Right.
Management is constantly pointing to the SEC's Project Crypto and the Genius Act as transformational events. And of course, there are those persistent, swirling rumors about Bitmine eventually being included in the S&P 500 as a passive index component.
We really need to explain why S&P 500 inclusion is the holy grail here. If that happens, it forces trillions of dollars of passive index funds, like your standard 401k retirement funds, to automatically buy the stock to match the index weighting, regardless of what the price is.
It creates blind, mandatory buying pressure.
Exactly. And the regulatory acts like the Clarity Act provide exactly what institutional capital craves, above all else, regulatory certainty. It legally legitimizes staking operations and permanently categorizes Ethereum as a distinct asset class, removing the fear that it will suddenly be prosecuted as an unregistered security.
But that fear is exactly why we need to look at the bear case. No serious wealth-building strategy is complete without thoroughly understanding exactly how you can lose your capital. The risks here are very real.
Oh, absolutely.
First, asset concentration. We spent the whole time talking about how brilliant it is to own 5% of all Ethereum to create a supply shock. But what happens if the crypto market fundamentally crashes?
Right. The leverage cuts both ways.
A 30 to 50% drop in the token price would absolutely crush their net asset value, and more importantly, it could trigger lethal margin calls on the debt they used to acquire those tokens in the first place.
And there is extreme regulatory risk, too. We just talked about the Clarity Act passing, but what if the opposite happens? If the SEC suddenly changes course and successfully labels the act of staking as an illegal, unregistered securities offering, the entire Maven revenue model breaks overnight.
Wow.
Yeah, the company would be paralyzed, and the legal compliance costs alone would be devastating to their cash runway.
Those are massive macro risks, but the specific risk I really want to focus on for you, the individual investor, is dilution risk. This is the silent wealth killer.
Yes, it is.
To acquire all this Ethereum, Bitmine frequently issues new equity. They literally create new shares of stock out of thin air and sell them to the public to raise cash to buy more tokens.
Yeah.
You have to watch the share count metric obsessively.
It's the most crucial and often ignored metric for a retail investor to monitor.
Right. If the net asset value of the company is growing because they are hoarding more tokens, but they are doubling the total number of shares in existence to do it, your individual slice of the pie is getting diluted. Owning a smaller percentage of a bigger company is not a guaranteed path to wealth.
You want to see the Ethereum per share metric actively growing, not just the total corporate treasury growing. If management gets sloppy and dilutes shareholders too aggressively to fund their alchemy of 5% dream, the underlying price of Ethereum could go to the moon, while your stock price stays completely flat because there are simply too many shares diluting the value.
Exactly. The plumbing matters just as much as the thesis. So let's synthesize all of these moving parts into a final investment thesis. Based on the fundamental pivot, the institutional backing, and the raw mechanics of the yield generation, Bitmine earns a bullish score of 8 out of 10.
It really has established itself as the premier New York Stock Exchange-listed proxy for Ethereum, offering that unique staking yield kicker that standard passive custody solutions simply do not possess.
And the target horizon for you here is a medium-term hold, which we define as a 6 to 12-month timeline. The strategy is to wait out the final volatile stages of this mini crypto winter, carefully monitor the geopolitical situation driving the safe haven narrative, and allow the time for that $310 million Maven revenue stream to fully materialize on their quarterly earnings reports.
Right, because proving that cash flow is what fundamentally transitions this company in the eyes of Wall Street from a speculative mining play to a legitimate yield-bearing digital asset firm.
It is an absolutely fascinating financial transformation to witness.
Right.
But I want to leave you with a final lingering question to ponder on your own as you consider this wealth-building strategy. Let's assume the grand plan works perfectly. If Bitmine Immersion Technologies actually succeeds in hoarding a full 5% of the global Ethereum supply, locking it away to generate corporate yield,
Yeah.
what does it mean for the future of a supposedly open, decentralized network when one single centralized Wall Street corporation wields that much concentrated power over the system? Something to think about.